All right. Good morning, everybody. New month, new quarter, new week, same same market. Nothing really surprising here. We're slightly gapped down, which gives me this mild bias that we're going to continue to go higher. That's a knee-jerk reaction. First thing I thought of this morning when I was checking the news, and it said, we were down, just mildly down. First thing I thought of. I can't show you the spot gamma levels like I had been in that little white cutout that said spot gamma because I can't find it. They changed things over the weekend, and I don't know where that particular little button is anymore. But we do have the same data here. We're looking at SPX, which the way they were always doing it, SPX and ES were shared on the same card, and then SPY had its own card. But either way, there's the levels. Screenshot them. We got ISM today. We got additional auctions this week. Non-farm payrolls on Friday is going to be the big deal, right? That's the one for the week. So something to really consider as we get closer to the end of the week, is how that's going to impact your portfolio. We got a lot of Fed speakers. Maybe using the word a lot might not be the right word, but we do have Fed speakers today, and there's the Japan bond auction today. It doesn't show that it's anticipated to be impactful, but we'll wake up tomorrow and see how impactful that was. I think they're sleeping on this one. I'd be prepared for a little bit of volatility with that. Right, so we can see with the Asian markets, they closed inside day, rallied back up off of all of those major moving averages. I didn't measure it, but it's really close to 50%. It's about as much as an indecision candle as we could get without actually seeing a doji sitting there. For Japan, sure, it's red, but it did gap up and then red. And for Europe, bar 4, just nice, clean expansion after a swing low pattern. Inside day breakout, nice continuation through the 50. This is looking really good, and it kind of bodes with the argument that I have that we're very likely going to continue the upward drive today. It doesn't have to be big, large expansions more and more and more every day, but I just don't see us selling off today, at least not at this point. We would need some news to come in. The fact that we're down slightly kind of completes that little wick below each of the trading days, right? When we start to move back up and you got the new candle open, a slight fade to get the close of the previous day, and then a rally up and into the next one and into the next one. So PMI, ISM, and then the 3 and 6 month auctions along with Fed speakers. We got European Central Bank speakers, and then we've got Cook here in the US at 4:15. one of the things to be listening for today is how the market is going to take this news of the OPEC cut. It's driving energy up. And on one side of the argument, we can see that as an inflationary measure, because higher energy costs, obviously, drive the cost of everything else. But there's also an argument right now that it's a deflationary measure, since it can shunt growth and cause, maybe a slowdown, because businesses who might want to start an endeavor or, expand an endeavor would look at that and say, no, let's wait, it's too expensive right now. And I'm inclined to believe it's more inflationary than disinflationary, but at this point, that's the argument. We have a very muted range this morning. It's a very narrow IB. If you think about the initial balance, starts at 6 o'clock, and we just measure a 1 hour open range. So from 6 to 7. And then we want to look at what the market did after that. And basically we did nothing. We peaked outside of it just a little bit on each side. We still have an MDP. We haven't hit that daily pivot yet. I'm inclined to believe today we're finally going to hit one. We had 3 in a row that we haven't hit, and right now we're running on day 4. I don't believe it. I think we're going to find it today. Volume is within line. Okay, we're looking at the cumulative volume starting at midnight, measured up until 7:30. A normal average overnight cumulative volume is somewhere between 1 and 200. So we just get that out of the way. So when we look at this very narrow range from the overnight session, it implies that there's still a lot of work to be done. And it also implies that any energy being built from this hasn't been spent yet. So when a move comes, it should come with the velocity of energy behind it. Energy is not necessarily a word we use often. If you think of the RSI Laguerre, it's about the only indicator I know that focuses on energy rather than things like momentum, inertia, trend. We had the classic J hook with a high gamma level this morning, and so far it's really not giving much. So we're inside day. Friday's range is really big. And the expectation is that if we stay inside of this range, the range from yesterday, it's very likely to be choppy, difficult, not clean, perhaps a little hard to trade. So if you're losing more often than you win and you're struggling with day trading, quit doing the hard stuff, start doing the easy stuff. One of the things we would classify as the hard stuff is trading in a range bound day when we're still sitting inside of our own Globex range and we're still sitting inside of yesterday's range. So it's not to say that you can't trade it or that it's untradeable. It's just going to be a little more difficult than, say, an expansion day where we've already broke out of the range from yesterday. All right. Through the morning today, we're going to lose this little bit of volume down here. Then we'll have a new bottom at around 39. I'm going to hedge this a little and say 39.50. It's not exactly 39.50, but it's close enough. 39.50 to 41.50. It's a 200-point range. Really solid bottom. Not a lot of volume up at these levels. And when we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. Well, we're at the high right now. The point of control is a long ways down. And other than a little bit of memory at 40.80, there's really not much to catch us. So if we do start breaking to the downside this morning, the move should be as swift back down as it was up through that level Friday. You can see how we didn't really leave a whole lot behind. Interesting too, I've got the TPO here in blue, and you can see how shallow it is at this level. It's where we paused right around noon, 1 o'clock. We got that nice pullback before just catapulting higher. Well, that pause ties in with all of this volume here. We had hit a ceiling, a massive level of liquidity, and the market pulled back, reassessed that, and just drove right through it with conviction. You can see we didn't spend a whole lot of time there, but we certainly garnered a whole lot of volume there. We've spent nearly 3 times as much time above that level than we spent at that level, and yet we've not even come close to the amount of volume that was there. That's why running these two profiles side by side can sometimes be a little insightful. TPO, time, price, opportunity. All right, we got a new VPOC. It's a Virgin point of control. It's a point of control that has not been hit yet today. All right, so we can see the red line from Friday. That's the point of control. Since Friday's close and the open in the Globex, we haven't gone down and hit that level. So it's called a VPOC. We now have a staggered level of VPOCs underneath us. Not this one. That's an old one that we managed to go through after having been on the chart for months. So 4 levels. I wouldn't be surprised if we retest that 41.16 VPOC today as a part of this pullback. Think about the move we had on Friday when we hit all of that volume that I was talking about, and we paused and had a really nice pullback. So it was a perfect pullback before catapulting up to the next level. It's basic trend 101. We'll take that and put it on, say, a 15-minute, 30-minute, or an hour. We're now getting that same pullback that we had here in the bigger run, where we're going to now get, a pullback to a 786 off of that higher measure from this run. We still have a gap close. Depending on which close we want to use. Right now, if we're looking at the last candle printed, that would be the 5 o'clock close. For you and me, the regular everyday trader, the market closes at 4, but then there's a 4:15 close, and then there's another close at 5 o'clock. So when we're looking at a gap here, and we're trying to figure out, well, which one of these actually closes the gap? The simplest way to answer this question so you don't feel like you're choosing the wrong close, is just to go out to the daily chart. You go out to a daily chart and you look at what the daily close was that your broker is using. Maybe a little simplistic, but it works. Now you don't have to worry that you picked the wrong one. Is it the 4 o'clock? Is it the 4:15? Is it the 5 o'clock? It doesn't matter. It's whatever the broker decided was close on Friday. Now you've got it marked. Simple enough. So we can see now that I've done that, the gap is not closed. So 4140, let's just round up, would be gap close. Above that, previous week's high. They're really close together. Just consider that entire area a liquidity zone. Now, I don't really get into this very often, but when it comes to supply and demand, rally kind of stuff, I want to see leg out. Otherwise, I don't really consider them useful demand zones and supply zones. So down here, for an example, we had that significant leg out. Same thing here when we had a rally base drop, RBD, with a big leg down. It didn't grind its way down in slow, small candles. We had those big leg candles. That's what I want to see, because that carries the implication of unfinished business and trapped traders. And the idea that when we come back to that level, there will be a response out of the market, like there was last night. So this is unfinished business up here. When we get back there, we're going to respond to it. We're going to pull back away from it at least once. It's a first touch rejection trade. That's a day done play. We just got to get there first. And as you can see, there's a significant level of resistance. We haven't been able to get there yet because we set this level during the kill zone, and we haven't been able to get past it. So a significant level, 41.37, then the close, 41.40, and then the previous week's high, 41.42. And all of these are close enough together that if you were trading on, the higher time frame, or at least doing analysis on the higher time frame, the entire thing would be a zone. It marked all of it out as one big level of resistance to get through. All right, we're getting a little extended above the 10-day moving average, but we're not extremely extended. So around 2% begins that discussion of, we're getting a little overbought. We're getting a little ahead of the skis. Perhaps we want to see the market pause, maybe slow down in its advancement. It doesn't have to turn around and go back towards the 10. All it has to do is stop advancing and let the 10 get caught up with it. So it doesn't have to, right? We can see on Friday, we made it almost to 2.5% away from the 10. And then now this morning, we're gapped down a little bit. If we look back at when it sets a peak, it very often gets reset first before it tries to come back up and set another peak again. So there are times where it sets a peak and then it continues to push just a little bit higher. But looking back, there's not very often that we see that. So here, for an example, it set a peak, it pulled back, and then the next day it actually went up even more. and then pulled back finally. So just because we have a peak and we've pulled back a little bit, we're not destined to go to the 10 yet. But more often than not, once we've set a peak and we have a gap down, or the next swab bar or histogram bar is lower than the previous one, generally speaking, that is the round that we're looking for. Look for these rounding moves, or it comes back to the 10 or really close to the 10, basically coming back into reset. So we want to watch the 10-day moving average, looking for a retest or even just a test of that 10 before continuing the push higher. And I still believe 4,200 is on the table. 4,211 really with the cog line up there before this current run is done. And it's interesting, there's a lot of market breadth that has been bandied about, talked about, say at stockcharts.com. They always do really good with breadth over there. And it's not done yet, right? This whole push. But there was a big, I didn't catch his name, but I recognize his not only his name, but his position. They talk about him on Bloomberg all the time. Some big Joe Schmo was out on Bloomberg saying that this tech run is overextended and that it's just about done. We're not likely to see another leg up. Now, you got to take that with a grain of salt. Certainly, they're going to be a little exhausted after the run that they've had. I wouldn't call them done yet. There's still a whole lot of market breadth out there that suggests that the 7 names that carried us all the way through the first quarter might be taking a break. But now every single thing else that didn't go is starting to pick up. So that dash for trash, left behind, short squeezed junk that nobody was looking at for the last quarter is now catching bid and starting to move. That's a whole rising tide push behind the market. So we might see this dichotomy where the tech stocks take a break, semiconductors take a break, because they've been doing all the heavy lifting. And we see the rest of the market carry the load a little bit. So I don't think we're done with this rally. Because of what OPEC did, that can all change today, because that is a new dynamic that wasn't here last week. So we don't know for sure, how that's going to affect the market. If it wasn't for that data point, I would be a lot more convinced that we're going to go to 42 plus. But now I'm still convinced, just not as strongly. Continuing to see that fade in the dollar. We want to see this break 102. Wouldn't surprise me if we get back to maybe even 101. Just really consider the idea of what the S&P would look like if the dollar got below 100. And we're not, this isn't the dollar, right? We're just using a little shorthand here. This is the US dollar index. Look at the move in the overnight hours last night. Consider this move a year ago. We would have seen the S&P ripping to the upside like a rocket ship, right? It looked like SpaceX headed back up into orbit. But think about what the S&P is doing this morning. We're still range bound inside of yesterday with a really, really tight zone. So we just reviewed the S&P. It's not doing anything. It didn't respond to this massive move in the dollar last night at all. And that should give you a little bit of pause. Because that is a significant move. Now, granted, there's 2 sides to this story. One is first, the dollar ran up last night, and then it fell all the way back down. So it's not down as much as it visually seems to be, since we opened at 102.6 and we're at 102.35. So, from where we opened, we're not down very much. But that's still a significant move in the overnight. Put that side by side with the ES. We had a little bit of a bid here where the ES came out of this range down here, ran back up, overshot the Globex high by a little bit. That's all that we got out of this entire move. So it kind of goes with the argument that seeing the dollar down isn't going to be enough. The dollar is going to have to break through some levels. Say the dollar below 102, getting into 101 half or below 101 half. That could give the S&P a rise above, say, 4150 and into 4200. Here we've got the 10-year. It's a little choppy in the overnight, so it's easier to use the line graph here. But the 10-year, after setting that really nice topping pattern last week, we're now headed to the downside with a really nice Busby. I mean, you got to admit, that's a textbook classic Busby. Solid support that finally broke, ran back up and retested that old support as new resistance. Now here things get a little weird because the dollar, when it ran up and tested this Globex high, was the same time that the 10-year had ran up and broke through its Globex high. So they were both moving up together and they both moved down together. Although, I mean, like I said, it's a little hard to see it. We'll use Heiken and Ashy just so we have a candle there. So we need these two to split apart again. The 10-year going up with the ES is only going to work for so long. Once the 10-year gets above, say, 3.7, gets into 3.8, it's going to start freaking the market out. And then there's going to have to be some decoupling. All right, so the 2-year significantly gapped down, hasn't closed the gap, still maintaining that gap down from the overnight. But we're catching a little bit of a bid. Same test of that Globex high. This is kind of showing that indecision from the effects of the OPEC announcement. The market really doesn't know which side of the coin that's going to land on, inflationary or deflationary. So these are the things you're going to want to watch for today for the continuation in this rally. All right, what's going on in the 10-year, the 2-year, the dollar. If we see another big leg down in the dollar like that, and we break below, say, that 101 half, it should equal a 4,200 breakout in the S&P. but only if we see a reflection in the bonds and in the yields. Nat gas down more than 5%, closer to 5.5%. Bitcoin down nearly 3.5%. The Bitcoin level is one of those levels that we've been using on a day-to-day basis for kind of a reflection of liquidity and the continuation of this rally. K-Web, Bitcoin, finance, tech. We've had all 4 of those. It seems like I'm missing one. That like there was 5 that was driving this push. So we don't have Bitcoin with us this morning. Tech's down slightly, not even 1%. So not necessarily enough out of tech yet. And finance is flat. So we got precious metals and energy, reflation trades. Still need to see finance start to come up with that. Yeah. If I didn't say it, then yep, that would be number 5. You're right. Somebody said maybe the 5th one was semiconductors. And if I didn't say semis, then yep, that was the other one. Using something like SMH or, the SOX, using, some sort of semiconductor ETF. And semis are down this morning too. But I still want to stress caution because with everything that has been carrying the market, it's due a pause, right? It's done all the heavy lifting for the last quarter. If they put the mantle down and let everything else carry the load, we're still going to hold these levels. We might not, rally as strong, but we won't crash either. We won't fall back down through, say, 4,100 and get into 39 and 3,800. If those other names are still, carrying the load. So in the NASDAQ, 7 names are up 0.5%. And in the S&P, 11 names are up 0.5%, which is not overly bullish, especially when a lot of those names are energy and minerals and utilities. For names that are down, 36% of the NASDAQ is down 0.5%. And I don't know, that might sound like a lot, but it's not, right? Just like when we had the same number last week that was up. It's not a lot. And the names that are down are basically the ones that were doing all the heavy lifting. All these semiconductors and the FANG names. So out of 500 names in the S&P, 7 did all the work. If they stop now and let the other 493 names start carrying the load, we can still hold these levels. So we want to see very clear, convincing signs that the other 490 names aren't going to do it. So looking at NY FANG and KRE, it's not going to be very helpful. Keep your eye on, say, the weighted AD, because it's actually reading sectors, right? It's weighted sectors, not a regular weighted advanced decline. You can also go into, say, Market Watch, Visualize tab, go to the index, and they've got pre-made lists for anything that says public. That's something that's pre-made. And then you've got your S&P sectors and industries. I know this looks like a lot. Don't bother trying to look at all these code, right? Because that's what they're using. It'll be a hashtag and a number. Just once the market's open, it's going to populate data up here. And you want to see, right, issues and capital. Follow the money, right? Then for the other one, this is industries. The other one is indices. It'll be your top 11 sectors. And again, it uses code. So if you put that in a watch list and use a description, it'll tell you which one of those, it'll tell you what the code is. Energy, materials, industrials, blah, blah, blah. So we're going to be looking for a capital rotation. Someone much smarter than me has used this phrase that I really like. If we don't get capital rotation, we will get volatility. Now, I'm not saying it the way they said it, but that's the gist of it, right? So we have to get this rotation or we're going to really see volatility pick up. And then, of course, there is still the idea that tech can sometimes just keep on going, right? Even if it is, quote, overbought, it can just keep on going. Apple's famous for that. Looks like we're getting that rotation. Consumer spending, consumer services, durables, health, and a little bit of finance. You see all of the FANG names, which are the big box, large market cap names. All of them are down. So if we're going to continue to see a rally, one thing that we need to see is these FANG names quit falling. They don't necessarily have to rally. And I think maybe a rally would be asking for too much. But if they stop falling and just hold the lows, the rest of the market can carry the load. It just can't fight against them, right? So if they continue to go down, I don't see how the market can hold these levels. And if we bring that back to the S&P, The fact that all those FANG names are down this morning and we're only mildly down, right? We've been able to hold this all night long. That move in the dollar didn't take us up, but it didn't take us down. And the move down in all the FANG names didn't take us down. We're just not rallying yet. So let's kind of wrap this up with some perspective. We need a good, healthy pullback. I'm going to run it from this Tuesday low, but you could go, a couple Fridays back. $4,100 basically would be a good, healthy pullback before a new leg up. And that kind of ties in with that liquidity that we were talking about from yesterday, the VPOC, that large amount of volume that was sitting there, that volume level from the profile. So we get a decent pullback, lasts maybe a day, and then we continue on to the upside. If we break below 4,100, it starts to call into question if it's really a pullback at all, and that maybe it's actually a change in structure, a change in sentiment. So if we pull back and we don't rally, but instead set a lower high, and we continue that move to the downside, the next level of concern is 50%, because there's a difference between not continuing the rally, which would be 786, and being bearish, which would be actually getting below 50%. Until we get below 50%, we're not bearish. And until we get below 786, this uptrend isn't dead. So we got some metrics here, right, to kind of lay out. Measuring all of last week's level, 50% is 40.61. It's the same level that I have marked out here. Right, but here on the 15-minute, I just used this pivot point. At least here on the weekly chart, we've actually got the weekly candle measured. It is the same thing. 40.61. Now, if you want to use something a little tighter, you can measure Friday's level. Using that metric, we're already below the 786. So the trend from Friday is already in question. And the 50% mark of that is 41.11, our cog line. All right, the NASDAQ just legged down. So we're going to very likely see this gulf widen between finance and technology. So when you're watching KRE and the NY FANG, look for the tech versus finance instead of tech and finance. So what will oftentimes happen with this is one will pause and the other will push. And then that one will pause and the other one will push. All right, so NY FANG doesn't move in the overnight, so it's still sitting at Friday's high. KRE is already, making moves here in the Globex. We're going to open gap down at NY FANG. What we want to be looking for are just the basic old school levels, right? Open, high, low, close. So want to focus on where it opened on Friday, because we're already going to be, well off those highs. If it can maintain inside of Friday's range, we're fine. It starts to break down below that, I don't know that the market can hold back against it. So at least it's a level to keep track of. And if we start to lose finance and tech, if they join back together, but to the downside, then that's a wrap and we'll leg down in the S&P. All right. It's a good start to the week, at least. It's going to be a big week with jobs. We got JOLTS this week and non-farm payroll. This is one of the Fed's, big data points, even though they keep saying job destruction isn't their goal. They've certainly been using it as a metric. So, right, we want to see that that they're accomplishing their goal. If unemployment comes in really light, market probably isn't going to like that. Right. So good news is bad news. Bad news is good news. Be ready for a change event. As we come into the top of that range, 4,200. Otherwise, everybody have a good day. Be careful, be safe. I'll see y'all tomorrow.